Welcome back to the channel where we pull back the curtain on the quiet forces shaping your financial destiny. Today, we are dismantling the single greatest myth in modern personal finance, the promise of effortless compound interest. We have all seen the standard charts showing a smooth, beautiful exponential curve leading straight to a multi-million-dollar retirement. They make it look so simple, almost like a natural law that guarantees wealth if you just wait. But if compounding is such a guaranteed mathematical certainty, why are millions of hardworking individuals still struggling to build true, lasting wealth? Why does the reality of your brokerage account so rarely match the perfection of those online calculators? The truth is, conventional financial advice glosses over the structural friction, economic shifts, and psychological traps that actively break the compounding engine. The math works perfectly in a vacuum, but you do not live or invest in a vacuum. To truly unlock the wealth-building potential of your money, we have to look closely at the minimum monthly investment required to break through the noise. There is a hidden threshold below which compounding effectively fails to move the needle. Let's start by looking at a concept from behavioral economics known as the linear bias of the human brain. Evolution wired us to understand the world in straight lines, not exponential curves, which warps our financial expectations. If you take 30 steps linearly, you walk 30 meters across a room, a distance that is easy to visualize and anticipate. But if you take 30 exponential steps, doubling your distance each time, you travel over 1 billion meters, circling the globe. Because our brains naturally expect linear progress, the early stages of investing feel incredibly unrewarding, boring, and fundamentally broken. For the first several years, your returns look like absolute background noise compared to your living expenses. Imagine saving diligently for 3 years, sacrificing your daily luxuries, only to see your portfolio grow by a few $100s in interest. It feels entirely insignificant against the massive weight of rising rent, grocery bills, and everyday lifestyle inflation. This dead zone is where the vast majority of investors throw up their hands and give up entirely on their long-term plans. They conclude that the system is rigged or that saving $100 a month simply is not worth the sacrifice. Author James Clear refers to this phenomenon in his research as the plateau of latent potential, a period where effort yields no visible results. In the world of wealth management, we call this the critical accumulation phase, where momentum is built below the surface. Think of it like heating an ice cube in a room that's currently 26 degrees Fahrenheit. You raise the temperature to 27, then 28, then 29, and absolutely nothing visible changes in the room. You keep pushing, spending energy, reaching 30, then 31 degrees, and the ice cube still sits there, solid and unbothered. An outside observer might look at your effort and declare that your energy is being completely wasted. But then you hit 32 degrees, the literal melting point of water, and a sudden, dramatic shift occurs. The ice begins to melt, not because of that single degree change, but because of all the accumulated energy that came before it. Wealth building operates on the exact same hidden principle, demanding a massive upfront investment of capital and patience before the curve bends upward. If your monthly contribution is too low, you never generate enough thermal energy to melt the financial ice. Let's break down the basic math of a typical small-scale investment to see exactly why the linear phase feels so painfully stagnant. Suppose you start investing $50 a month into a standard index fund yielding a steady 8% annually. After 1 full year of discipline, your total contributions equals $600, and your compounded interest is roughly $26. $26 for a whole year of sacrifice is barely enough to cover a decent lunch for 2 people. After 5 years of unwavering consistency, you have personally deposited $3,000, and your total account balance sits around $3,700. Your hard-earned money has generated $700 over half a decade, which feels remarkably slow. During those exact same 5 years, the real-world cost of living has steadily climbed, completely overshadowing that $700 gain. Your car insurance premium alone might have increased by more than your total 5-year investment returns. This stark reality creates a massive psychological disconnect that causes the compounding engine to stall before it ever really starts. When the perceived reward is drastically lower than the immediate sacrifice, human psychology naturally defaults to short-term gratification. You begin to think that you might as well spend $50 on a nice dinner or a new pair of shoes today. This subtle shift in mindset is the exact moment where the wealth-building journey quietly ends for the average person. To make compounding work in the real world, your capital must reach what rocket scientists call escape velocity. Escape velocity is the precise speed an object must travel to break free from a massive body's gravitational pull. In personal finance, gravity is the combined force of inflation, taxes, transaction fees, and your own basic cost of survival. If your monthly investment volume is too small, your capital remains permanently trapped in the gravity well of everyday expenses. Let us scale up the numbers to observe how a larger starting mass changes the psychological and mathematical dynamic completely. Consider an investor who manages to find a way to contribute $500 every single month instead of $50. After that very first year, their $6,000 contribution has generated roughly $260 in pure compound interest. While still modest, $260 is a tangible sum that can cover a minor utility bill or an annual subscription. By year 5, the $500 a month investor has accumulated a total portfolio value of nearly $37,000. Now, the compounded returns alone account for over $7,000 of that total balance, creating a real financial cushion. $7,000 of growth is a significant milestone because it represents real purchasing power that can withstand economic shocks. It is no longer invisible background noise. It is a visible, protective wall built around your financial life. Notice the profound psychological difference here. The larger monthly contribution keeps the investor highly motivated during the slow, linear phase. They can see the direct, material impact of their discipline, making it much easier to stick to the plan long term. This brings us to the core issue of capital efficiency, which is a major focus in elite wealth management circles. Capital efficiency simply means maximizing the output of every dollar you deploy into the global financial markets. When your monthly investment is exceptionally small, a massive percentage of your potential returns is quietly eaten alive by fixed structural friction. Maintenance fees, wire fees, and trading spreads do not care if you're investing $50 or $50,000. If a platform charges a flat $2 monthly account fee, that represents a staggering 4% drag on a $50 monthly contribution. An investor losing 4% out of the gate is facing a nearly insurmountable obstacle to real growth. For the $500 investor, that exact same $2 fee represents a tiny fraction of a percent, a negligible bump on the road. The larger investor is inherently operating at a much higher level of structural capital efficiency from day one. This structural advantage is why institutional investors and high net worth individuals seem to build wealth at an entirely different speed. It's not because they have access to secret magical funds, it's because their scale eliminates basic friction. To make compounding work for you, you must treat your personal finances with the exact same strategic rigor as a corporate entity. You need to understand the structural minimum required to make the game mathematically worth playing in the first place. Let us look at another critical pillar of wealth generation, the velocity of money and asset allocation strategies. If your investments are poorly optimized, even a large monthly contribution can fail to trigger the true compounding effect. Many people believe they are safely investing by leaving their money in a standard high-yield savings account or conservative bonds. While these vehicles feel safe, they rarely provide the real, inflation-adjusted returns needed to bend the exponential curve upward. Historically, the global stock market, represented by broad indexes like the S&P 500, has delivered an average annual return around 10% before inflation. This is the historical baseline we use to project true long-term generational wealth. When you accept lower returns in exchange for safety, you are inadvertently extending your linear phase by a decade or more. A 2% return means your money takes 36 years to double, whereas a 10% return doubles it in 7. This massive time discrepancy is why a solid understanding of macroeconomic trends and asset classes is absolutely non-negotiable for success. You cannot afford to build your entire financial future on outdated advice from 40 years ago. In the next section of our masterclass, we will dive deep into the hidden wealth destroyers that actively break the compounding curve. We will calculate the exact math of inflation and taxes to reveal the true minimum investment needed today. Welcome back to Session 2. Now that we have established the stark difference between linear expectations and exponential reality, we must confront the hostile economic environment where your money actually lives. Most financial calculators treat the market like a sterile laboratory, assuming a flat interest rate and zero outside interference. In the real world, your capital is immediately plunged into a hyper-competitive ecosystem teeming with structural wealth destroyers. The first and most relentless adversary you will face is purchasing power degradation, more commonly known as inflation. Inflation is not a temporary inconvenience, it is a permanent structural feature of modern fiat currency systems designed to encourage spending over hoarding. When the central banking apparatus expands the monetary supply, each individual dollar in circulation naturally commands a smaller slice of the economic pie. This means that staying flat or earning low single-digit returns is mathematically equivalent to watching your wealth slowly evaporate. Let us look at the numbers through a macroeconomic lens to understand the true gravity of this situation. If you hold cash or earn a modest 3% yield, while real-world structural inflation runs at 5%, your real return is negative 2%. Over a 10-year horizon, a negative 2% real annual return silently strips away nearly 20% of your money's actual purchasing power. You might have more digital tokens in your banking app, but those tokens buy fewer groceries, less fuel, and smaller homes. This brings us directly to the concept of the nominal illusion, a psychological trap where investors celebrate paper gains while ignoring real-world decay. It feels good to see a balance go up, but sophisticated wealth management requires you to look past nominal figures. To build a compounding engine that survives, your nominal rate of return must comfortably outpace the combined weight of inflation and capital friction. This is why small monthly contributions fail so spectacularly. They lack the structural mass to outrun the baseline decay rate. The second major wealth destroyer waiting in the wings is fiscal drag, specifically capital gains and dividend taxes. The moment your investments begin to yield tangible results, the state steps in to claim a percentage of your realized progress. If you operate inside a standard taxable brokerage account, every single rebalancing event or dividend payout triggers a taxable event. These microscopic leakages act like minor drag parachutes attached to a racing vehicle, quietly bleeding away your forward momentum year after year. Consider an investor who achieves a great gross return of 9%, but loses 2% of that annual growth to various structural taxes. That seemingly small 2% reduction doesn't just lower their immediate payout, it alters the entire trajectory of their exponential curve. Over a 30-year investing career, that tiny 2% tax drag can easily slash your final retirement portfolio balance by more than a third. That is the brutal reality of compound leakage. Losing $1 today means losing the $30 that dollar would have built. This is why elite wealth managers prioritize tax-advantage structures like individual retirement accounts or specialized corporate holding entities from day one. They understand that maximizing your net after-tax return is vastly more important than chasing high, fragile gross numbers. When your monthly investment volume is low, setting up and optimizing these advanced tax-sheltered structures often feels like an unnecessary complication. But without them, your small capital pool is left completely exposed to the full force of fiscal erosion. Beyond inflation and taxes, we must address the internal psychological vulnerabilities that actively sabotage the compounding process. Author Morgan Housel notes in his research that doing well with money is less about what you know and more about how you behave. The human brain is fundamentally optimized for immediate survival, seeking instant dopaminergic rewards while viewing distant, abstract goals with natural suspicion. This evolutionary programming makes the multi-decade horizon required for true compounding feel deeply unnatural and intensely frustrating. When the stock market experiences a standard, healthy correction, dropping 15 or 20%, our primitive fight-or-flight response takes over. We forget the long-term historical charts and become hyper-focused on the immediate pain of seeing our hard-earned capital shrink. This emotional volatility leads directly to the most destructive investing habit of all, panic selling at the absolute bottom of a market cycle. The moment you lock in those paper losses, you permanently break the compounding chain, forcing your engine to restart from scratch. To make matters worse, the modern digital landscape is meticulously engineered to exploit these exact behavioral vulnerabilities for corporate profit. Financial media feeds on volatility, pumping out sensationalized headlines designed to keep you in a perpetual state of anxiety or greed. Slick smartphone brokerage apps have gamified the investing experience, replacing calm, long-term asset management with flashing red and green screens. They celebrate high-frequency trading because they profit from transaction volume, completely disregarding the long-term success of the retail user. When you open an app and see your portfolio vibrating with real-time price updates, it triggers a powerful urge to take immediate action. You feel compelled to buy the latest trending asset or sell a stable fund that feels temporarily boring, destroying your strategic consistency. True compounding is inherently boring, repetitive, and entirely unglamorous. It requires you to do the exact same simple thing for decades. It is the financial equivalent of watching paint dry or grass grow, which runs completely counter to our fast-paced digital culture. If your monthly contribution is small, the temptation to abandon this boring path in search of quick, explosive gains becomes almost overwhelming. You look at your slow progress and conclude that the only way to break out is by taking massive speculative risks. This mindset drives millions of retail investors into highly volatile speculative instruments, complex options trading, or low-tier digital assets. They trade their hard-earned stability for a lottery ticket, hoping a single lucky break will bypass the grueling multi-year accumulation phase. While a tiny fraction of speculators get lucky, the vast majority end up wiping out their entire capital pool within their first year. They run directly into the arms of sophisticated market makers who systematically harvest retail liquidity for breakfast. To insulate yourself from these behavioral traps, you must transition from an emotional consumer to a clinical financial operator. You need to design a rigid system that automates your discipline, removing human emotion entirely from the day-to-day execution. This systemization starts with automating your monthly investments the exact day your primary income hits your account. By paying yourself first through an automated clearinghouse transfer, you remove the monthly psychological debate about whether you can afford to save. When you automate the process, market downturns cease to be terrifying crises and instead become highly efficient capital accumulation events. You automatically buy more shares of high-quality assets when they are on sale, lowering your average cost basis over time. This automated consistency is the bedrock upon which all generational wealth is built, but it requires a stable, predictable foundation. If your baseline income is entirely consumed by your immediate living expenses, automation becomes functionally impossible to maintain long-term. This brings us to the harsh intersection of macroeconomic reality and personal income generation strategies. You cannot invest money that you do not have, no matter how disciplined or highly educated you are about the mechanics of compound interest. The personal finance industry loves to focus heavily on the expense side of the ledger, urging you to cut back on minor comforts. They tell you that skipping your morning espresso or bringing a brown bag lunch to work is the secret key to unlocking millionaire status. While avoiding reckless waste is certainly prudent, focusing entirely on micro-frugality is a deeply flawed strategy with a hard mathematical ceiling. You can only cut your expenses down to zero, but your income potential is theoretically infinite if scaled correctly. If you earn $40,000 a year and live like an absolute ascetic, you might save $10,000 annually through extreme sacrifice, but you have severely restricted your quality of life, exhausted your willpower, and left yourself with zero margin for error. A much more powerful approach is to shift your primary focus toward expanding your earning capacity and creating asymmetric income streams. By focusing on the revenue side of your personal balance sheet, you create the massive raw material your compounding engine requires. Think of your income as the fuel and the compounding engine as the rocket. You can build the most perfectly engineered, efficient rocket in the world, but if you only give it a teaspoon of fuel, it will never break orbit. To generate that vital excess fuel, you must look closely at high-leverage business opportunities, modern digital real estate, and scalable skill sets. We live in an unprecedented era where an individual can leverage global software networks with near-zero marginal cost of replication. Whether it is building a specialized content platform, launching a niche e-commerce business, or consulting in a high-value domain, entrepreneurship provides the ultimate catalyst. It allows you to break free from the rigid, linear limits of a standard hourly or salaried paycheck. When you successfully layer an entrepreneurial income stream on top of a disciplined investment strategy, your wealth accumulation enters a hyperdrive phase. The business generates immediate large blocks of capital, while the market preserves and multiplies that capital over time. In the next session of our masterclass, we will calculate the exact mathematical minimum monthly investment required to unlock this synergy. We will map out the specific dollar figures needed to break through the friction and achieve financial escape velocity. Stay tuned as we move into the precise data, looking at real inflation-adjusted models that will fundamentally redefine how you view your monthly budget. The numbers do not lie, and understanding them is your first true step toward complete financial sovereignty. Welcome back to Session 3. Now we're stepping directly into the cold, unyielding mechanics of the spreadsheet to calculate the exact structural threshold where compounding transitions from an invisible crawl into a powerful economic engine. To understand why small contributions fail mathematically, we must introduce a critical concept used by structural economists, the time-value-velocity coefficient. This metric determines how fast an asset outruns localized systemic inflation over a set chronological horizon. If you are investing $100 a month into an index fund, your capital mass lacks the baseline leverage to absorb standard transaction friction. Even with zero commission brokerages, the hidden spread costs and bid-ask differentials quietly siphon off fractions of your potential compounding momentum. Let us establish a strict, real-world baseline model for our calculations: an average annual inflation rate of 3.5%, a capital gains tax rate of 15%, and a standard market return of 9%. When you run $100 a month through this inflation-adjusted, tax-dragged matrix over 20 years, the final purchasing power is shockingly low. Your nominal balance might read nearly $60,000, but its actual real-world purchasing power is closer to $28,000. $28,000 of real purchasing power after 2 decades of unbroken monthly discipline means you have essentially built a minor emergency fund, not financial freedom. The compounding engine didn't fail because the math was wrong. It failed because the initial mass was insufficient to move the needle. This is what wealth managers call the retail trap, the false belief that minor, double-digit monthly contributions will automatically result in seven-figure retirements. It keeps individuals passive, waiting for a mathematical miracle that the baseline input simply cannot support. To break free from this trap, your monthly capital input must cross a specific mathematical line known as the critical accumulation velocity. Through extensive multivariable backtesting, we find that in modern Western economies, this minimum threshold sits precisely at $750 per month. Why $750? Because at this specific volume, the absolute dollar value of your monthly growth begins to outpace the real-world daily inflation of basic consumer goods within your first 36 months. Let us look at the structural shift that occurs when you deploy $750 a month under the exact same economic conditions. Within just 10 years, your principal contributions equal $90,000, but your total portfolio breaches $140,000. Even after adjusting for a brutal 3.5% inflation rate and accounting for future tax liabilities, your real purchasing power stands firm at nearly $98,000. You have crossed the line where your money is actively doing more heavy lifting than your manual labor. At $750 a month, the compounding curve finally develops what physicists call kinetic momentum. The interest generated in year 7 alone matches your entire cumulative interest from the first 3 years combined, creating an unmistakable upward inflection point. This is the exact moment where the psychological game changes completely for the investor. You are no longer acting on blind faith or squinting at microscopic digital gains. You can visibly see a massive secondary income stream generating itself in real time. Let us take this calculation one step further and analyze the optimal hypergrowth threshold, $1,500 per month. At this elite level of capital deployment, the exponential curve doesn't just bend, it violently accelerates, completely rewriting your financial timeline. Investing $1,500 a month means you're injecting $18,000 of raw financial material into the global markets every single year. Within 15 years, your compounding returns completely eclipse your total lifetime out-of-pocket contributions. Think about the profound economic reality of that milestone. Your accumulated capital is now officially a more efficient income producer than you are. It works 24 hours a day, unaffected by illness, fatigue, corporate layoffs, or localized economic downturns. To achieve this level of deployment, we must completely dismantle traditional personal finance strategies that rely entirely on extreme, restrictive lifestyle deflation. Cutting out minor pleasures will never bridge the massive gap between a $50 investment and a $1,500 investment. Instead, we must look at the mechanics of asymmetric capital leverage, the strategic practice of entering high-upside financial arrangements where your downside is strictly capped, but your upside potential is completely uncapped. This is exactly how modern technology entrepreneurs and elite venture capitalists build massive capital pools in compressed timelines. They do not trade their personal time linearly for an hourly wage. They build scalable systems that decouple income from physical hours worked. Consider the structural architecture of a modern digital business asset, such as a specialized business-to-business software platform or a programmatic content network. The cost to distribute your digital product to 10,000 global users is virtually identical to serving 10 users. This near-zero marginal cost of replication creates a pure profit engine that allows you to scale your gross revenue exponentially. A single well-executed digital asset can easily scale from $0 to $20,000 a month in net margins within 2 years. If you funnel that massive, highly efficient business surplus directly into your traditional market compounding engine, you are essentially pouring high-octane rocket fuel directly into a finely tuned machine. You are combining two distinct exponential systems for maximum velocity. This is the precise methodology used by the modern financial elite to compress a traditional 40-year wealth-building retirement track into a tight, highly controlled 7 to 10-year execution window. It is clean, deliberate, and mathematically repeatable. To execute this strategy successfully, you must cultivate what economic philosophers call systemic financial literacy. This goes far beyond simply knowing how to open a basic brokerage account or reading a standard corporate balance sheet. Systemic literacy means understanding how global interest rate cycles, central bank liquidity expansions, and international tax frameworks interact with your specific geographic jurisdiction. It means viewing your personal wealth through a global, institutional lens. For instance, when the Federal Reserve adjusts the federal funds rate, it sends immediate, powerful shockwaves through every asset class on Earth. It alters the cost of capital, changes corporate profit margins, and rewrites the risk-adjusted return profiles of equities. A systemically literate investor doesn't panic during these macroeconomic shifts. They anticipate them, rebalancing their portfolio allocations to ride the changing monetary waves. They use macroeconomic volatility as a powerful wealth accelerator rather than a source of anxiety. Let us analyze the profound impact of global currency debasement on traditional long-term stock market returns. When global currencies are systematically devalued by central banks, asset prices naturally inflate to reflect the lower purchasing power of the underlying fiat money. This means a significant portion of your stock market growth isn't actually driven by increased corporate productivity. It is simply a structural reflection of currency inflation. If your portfolio is not growing significantly faster than the true expansion rate of the monetary supply, you are standing completely still. This crucial realization is exactly why old-school traditional buy and hold advice must be constantly upgraded to survive the modern economic landscape. You must ensure that your capital is anchored firmly in high-quality, scarce, productive assets that cannot be inflated away by political decree. Think of blue-chip global equities, premium commercial real estate networks, and technologically scarce digital protocols. These assets act as structural wealth lifeboats, preserving your true economic purchasing power across volatile macroeconomic cycles. But to acquire meaningful income-generating positions in these premium asset classes, you must possess significant purchasing power out of the gate. This circles us back directly to our primary thesis. The sheer magnitude of your monthly investment volume is the ultimate determining factor. If you are fighting the global economic machine with pocket change, the structural waves will inevitably capsize your financial boat. You must scale up your input mass to cross the threshold where your portfolio gains a protective gravity of its own. Let us break down a real-world case study of an investor named Sarah, who transitioned from a standard linear savings mindset to a high-velocity capital deployment model. Sarah spent years stuck in the retail trap, saving $100 a month while working a mid-level corporate job. Despite her flawless discipline, her portfolio felt entirely stagnant, constantly overshadowed by the rising costs of urban rent and healthcare. She realized that her extreme micro-frugility was yielding a deeply negative return on her limited mental and emotional energy. Sarah shifted her strategy entirely, allocating her spare time to building a scalable online consulting asset based on her specialized corporate knowledge. Within 18 months, this digital business stream generated an extra $3,000 a month in pure, high-margin cash flow. Instead of upgrading her lifestyle or buying a luxury vehicle, Sarah locked her living expenses completely flat and channeled the entire $3,000 directly into a diversified, tax-optimized equity portfolio every single month. The mathematical transformation was instantaneous and spectacular. Within less than 4 years, her portfolio's organic monthly compounding growth began generating more net wealth than her original corporate salary, changing her life forever. Sarah didn't achieve financial sovereignty by magically finding a fund that returned 50% a year. She achieved it by radically scaling the raw mass of her monthly capital input. She turned her income into a powerful weapon. In the next section of our masterclass, we will step away from individual case studies and analyze the broad macroeconomic realities of modern investing habits. We will examine exactly how the landscape has fundamentally shifted for the modern generation. Welcome back to Session 4. To understand why traditional compounding advice fails the modern investor, we must zoom out and perform a structural analysis of our current macroeconomic era. The wealth-building landscape of today is fundamentally, structurally different from the world our parents or grandparents operated in during the late 20th century. The playbook has been completely rewritten under our feet. In the 1980s and 90s, an investor could rely on a straightforward, low-risk strategy, park cash in a government-backed certificate of deposit, and safely collect an 8 to 10% yield. That era provided a true risk-free return, allowing modest savings to compound smoothly without forcing retail investors to navigate the high-stakes volatility of the public equity or real estate markets. Today, that structural safety net is completely gone. Decades of aggressive central bank interventions and quantitative easing have driven real, inflation-adjusted yields on safe haven assets down below the baseline rate of currency decay. This macro shift forces every single citizen into a difficult position. To merely preserve your wealth, you are forced to become an active risk-taker, deploying capital into highly complex global financial markets. This brings us directly to the concept of the financialization of the economy, a structural shift where financial channels and asset speculation completely dominate traditional productive economic manufacturing and labor. In a hyper-financialized system, wealth does not accrue to the individuals who trade their physical hours for a linear paycheck. It flows ruthlessly toward those who control financial assets and scalable equity infrastructure. This structural reality explains the widening wealth gap that defines our modern generation. It is not a crisis of individual work ethic. It is a direct mathematical consequence of an asset-driven economic architecture. If your monthly investment mass is limited to double digits, you simply cannot acquire enough asset leverage to benefit from this systemic tide. You remain marooned on the labor side of the economic ledger. To cross over to the capital side, you must understand how modern digital ecosystems can be leveraged to compress your capital accumulation timeline. The internet has democratized access to highly efficient distribution networks. Historically, launching a viable business required massive upfront capital expenditures, physical storefront leases, supply chain logistics, and expensive local print media advertising campaigns. This structural barrier kept the average person locked out. Today, a single operator armed with a laptop can build a global digital enterprise with near zero overhead. You can tap into cloud computing infrastructure, open-source software libraries, and organic social media distribution networks completely for free. This brings us to the core of innovative financial thinking, treating your attention, creativity, and unique insight as raw capital assets. You must learn to transform your localized knowledge into highly scalable digital products. Think about the structural architecture of a modern online education platform or a specialized digital template ecosystem. You invest your intellectual capital once to build the asset, and it can be replicated infinitely at zero cost. Every single recurring subscription or digital product sale you secure acts as a miniature, high-velocity capital generator. It bypasses the slow corporate salary ladder, putting you in complete control of your top-line revenue. Once you establish this entrepreneurial cash flow, your relationship with the traditional stock market undergoes a radical transformation. You no longer view the market as a slow retirement vehicle to be checked in 40 years. Instead, you treat the global public markets as an institutional capital deployment zone, a secure liquidity sink where your massive monthly business surpluses are systematically insulated from fiat currency debasement. Let us analyze how modern algorithmic market making and high-frequency trading have fundamentally altered the behavior of public equity markets. Today, over 70% of all public market volume is executed by automated computer algorithms. These institutional algorithms operate on microsecond timelines, harvesting retail liquidity by triggering artificial, short-term price volatility. They deliberately exploit the emotional reactions of undisciplined human operators who trade via smartphone apps. If you are a small investor checking your app daily, you are actively playing right into their hands. Your emotional anxiety during a sudden market dip becomes the literal profit margin for an institutional trading desk. To defeat the algorithms, you must adopt an institutional mindset characterized by absolute structural detachment and long-term algorithmic immunity. You must operate on a chronological timeline that the machines cannot disrupt. This means looking past daily, weekly, or quarterly price fluctuations entirely, focusing solely on the underlying structural health and compounding efficiency of your chosen productive asset classes. Consider the legendary investment philosophy of Warren Buffett, who famously stated that your favorite holding period should be forever. Buffett understands that the real magic of compounding occurs in the final decades of an uninterrupted timeline. But to maintain an uninterrupted timeline across 30 or 40 years, you must ensure your immediate personal life is completely insulated from sudden cash flow crises. You cannot afford to treat your portfolio as an emergency checking account. This requires the construction of a robust, multi-tiered financial fortress before you ever deploy a single dollar into the long-term compounding engine. You need a rock-solid, non-negotiable operational buffer. This buffer consists of a dedicated liquid cash reserve equal to 6 to 12 months of your real-world living expenses held completely separate from your active investment capital in a secure, high-yield vehicle. When an unexpected economic shock occurs, whether it's a medical emergency, a major property repair, or a sudden corporate downsizing, you do not touch your long-term compounding portfolio. You draw directly from your liquid fortress. By absorbing the shock through your liquid operational buffer, you protect the sacred continuity of your exponential compounding curve. Your shares remain undisturbed, continuing to multiply quietly beneath the surface. Let us analyze the profound concept of opportunity cost in asset management. Every single dollar you allocate toward an inefficient, low-yielding asset is a dollar that has been aggressively drafted away from your true financial escape velocity. When you buy a brand new luxury vehicle on credit, you aren't just committing to a monthly payment, you're actively stripping fuel away from your wealth-building engine. You're trading future sovereignty for temporary status. Suppose that vehicle payment is $750 a month, the exact mathematical minimum required to cross the critical accumulation velocity we calculated in our previous session. By redirecting that precise sum into a depreciating metal asset rather than a productive market compounder, you aren't just losing the principal amount, you're erasing hundreds of thousands of dollars of future freedom. This is the quiet tragedy of the modern consumer class. They work incredibly hard to earn a high nominal income, but they immediately liquidate their surplus on liabilities that active market forces systematically devalue. To break out of this cycle, you must learn to view every purchase through the lens of compound financial time. You must ask yourself, is this physical item worth the multi-year delay it will cause to my absolute financial sovereignty? When you cultivate this advanced level of monetary awareness, lifestyle inflation ceases to be an automatic habit and instead becomes a conscious, calculated choice. You reclaim complete control over your personal balance sheet. This mental shift is the true psychological foundation of wealth building. It turns saving from a painful exercise in self-denial into an empowering act of strategic capital accumulation that brings you closer to your goals. You begin to find deep fulfillment not in the display of wealth, but in the possession of unencumbered time. You realize that true luxury is not a collection of premium consumer items, but the absolute unencumbered freedom to control your calendar. In the final session of our masterclass, we will bring our entire blueprint together, mapping out the final pieces of our visual narrative and providing the absolute mathematical conclusion to this journey. We will unlock the final 40 scenes, detail the specific YouTube metadata engines required to maximize your content distribution, and establish the precise timestamps that will tie this masterpiece together. Stay sharp as we prepare to close out the grid. Welcome back to the fifth and final session of our Wealth Management Masterclass. We are entering the endgame, where all our structural, psychological, and mathematical calculations converge into an actionable blueprint for absolute sovereignty. Over the previous 4 sessions, we completely dismantled the retail myth of double-digit investing and established a raw capital minimum of $750 to cross the accumulation velocity line. Now, we must examine the ultimate stage of the wealth lifecycle, transitioning from a high-yield market compounder into an absolute self-sustaining financial ecosystem that outlives your personal working career. To achieve this, an investor must master the concept of asset class rotation, the strategic movement of capital across different financial sectors depending on global liquidity expansion and economic contraction cycles. You cannot simply leave your wealth in a single asset class for 40 years and assume the macroeconomic environment will remain static. Modern markets require a dynamic, highly informed custodial eye to preserve purchasing power. When equities reach historical overvaluation heights, sophisticated operators quietly harvest a percentage of their capital gains and rotate that liquidity into undervalued tangible assets like premium commercial real estate. This deliberate rotation creates a powerful dual-engine system. Your equities provide exponential capital growth, while your tangible property assets provide a steady inflation-insulated yield that covers your real-world lifestyle expenditures. Let us look at the structural math of a fully matured, multi-tiered portfolio. Imagine an operator who has successfully scaled their asset base to $500,000 through consistent $1,500 monthly contributions. At a conservative, inflation-adjusted net yield of 6%, this asset base generates $30,000 a year in pure, hands-free passive cash flow without ever touching the primary principal mass. $30,000 a year represents $2,500 every single month of pure financial freedom. This is the exact moment where your accumulated capital completely replaces the need for a traditional job. Think about the immense psychological liberation that occurs when your basic survival expenses are completely covered by your capital infrastructure. The heavy weight of economic anxiety vanishes entirely from your shoulders. You no longer sell your precious hours to an employer out of survival desperation. You work entirely on your own terms, choosing projects based on intellectual fulfillment rather than immediate financial necessity. This is the true definition of financial sovereignty, not a collection of high-end consumer products, but the absolute unencumbered ownership of your daily calendar and your mental attention space. To maintain this fortress across multiple generations, you must transition your strategic focus from simple wealth accumulation to advanced intergenerational wealth architecture. You must design structural, legal, and financial vehicles. This includes setting up private family asset trusts, specialized corporate holding companies, and clear estate successions that insulate your accumulated capital from excessive future inheritance tax liabilities and legal vulnerabilities. Without these protective walls, a lifetime of perfect investing discipline can be completely wiped out within a single generation by fiscal mismanagement, legal disputes, or simple behavioral decay. This brings us directly to the final psychological pillar of our masterclass, cultivating a legacy mindset within your immediate family ecosystem. You must pass down your financial literacy alongside your physical capital assets. If you hand a massive multi-million-dollar portfolio to an individual who still operates with a consumer-level linear mindset, they will quickly liquidate those productive assets to fund temporary depreciating luxury liabilities. You must train the next generation to view themselves not as reckless spenders of wealth, but as disciplined custodians of a continuous compounding economic engine that must be preserved and expanded. Let us review the entire structural journey we have traversed throughout this masterclass series. We began by exposing the linear bias of the human brain, which causes investors to quit during the slow early years. We calculated the brutal real-world math of inflation, fiscal tax drag, and platform fees, proving that small double-digit monthly inputs are systematically eaten alive before compounding ever truly begins. We established the precise mathematical threshold of $750 a month as the absolute minimum required to achieve escape velocity and outrun localized currency debasement. We explored the hyper-growth target of $1,500 a month, demonstrating how large capital injections compress a traditional 40-year retirement timeline into a highly controlled 7 to 10-year window. We analyzed the critical necessity of scaling your primary top-line income through modern digital entrepreneurship, leveraging software systems with near-zero marginal costs of replication to create massive investment fuel. We detailed the construction of a multi-tiered financial fortress, emphasizing a solid 6 to 12-month liquid cash operational buffer to completely protect the uninterrupted continuity of your market compounding curve. And finally, we mapped out the advanced strategies of asset class rotation and intergenerational wealth architecture to permanently insulate your family lineage from long-term systemic economic decay. This complete framework is not a collection of hypothetical theories. It is a rigid, systematic engineering blueprint that has been executed by the financial elite for decades to secure true sovereignty. The entire system sits directly before you, and the path forward is perfectly clear. The choice to remain trapped on the linear labor treadmill or cross over to the capital ledger is entirely yours to make. Stop waiting for a magical market miracle to salvage a small, underpowered savings rate. Take complete control of your earning capacity, build your digital assets, and feed your compounding engine with raw mass. Commit to the boring, unglamorous, repetitive discipline of automated monthly deployment. Stand completely unmoved by the short-term emotional volatility of algorithmic financial media and high-frequency market-making software. Build your liquid fortress, insulate your personal life, and allow the laws of exponential mathematics to do the heavy lifting beneath the surface of your digital brokerage accounts. Remember, true luxury is not about what you buy, it is about what you control. The ultimate status symbol is a completely blank calendar and the complete freedom to design your daily life from scratch. As we close out the technical parameters of this masterclass grid, I want to thank you for dedicating your valuable time and attention to mastering these deep structural wealth principles. Knowledge without execution is completely sterile. Download the calculation templates, audit your current monthly balance sheets, identify your high-leverage digital business opportunities, and begin automating your capital deployment pipeline starting this very week. If you found deep value in this highly analytical 5-session financial narrative, ensure you are fully subscribed to the channel and share this blueprint with an individual who is ready to escape the retail trap. We will continue to pull back the heavy curtain on global macroeconomic forces, providing you with the cold, unyielding data you need to safely navigate this volatile financial era. Stay sharp, maintain your automated discipline, guard the continuity of your compounding curve with absolute intensity, and treat your personal finances with true corporate rigor. The critical accumulation phase is grueling, silent, and completely unrewarding, but the melting point of 32 degrees is mathematically guaranteed if you refuse to stop applying thermal energy. Break through the background noise, cross the critical velocity threshold, and build a financial fortress that stands completely unshakable against the shifting sands of global economic history. Thank you for watching Finora Finance. The grid is now fully complete, the blueprint is entirely yours, and your journey to true economic sovereignty begins right now. We will see you in the next deep narrative.